Hey guys, it is RC Peck with Fearless Wealth. Thanks so much for being here. I am noticing something really unusual going on, and the unusualness is happening in a place that most people will not expect to happen. Now, if you look at the screen here on the top part of it, that is the iShares 20-year US Treasury bond. It's TLT, and that includes dividends reinvested. And then on the bottom half, that is the S&P 500. Actually, it's SPY with dividends reinvested. So let's call the top half bonds. Let's call the bottom half stocks. Okay, I want to talk about volatility. And the reason I want to talk to you about volatility and why you should care is because the volatility is not showing up in the stock market. In fact, it's showing up in the bond market. But most people have been led to believe that volatility is only a stock characteristic. And I believe most people are not prepared for volatility in the bond market. And I want to show you where that can get someone hurt. So we're going to look at the bottom chart, and I'm going to show you a 6.7% fall. So 6.7% is about between those two blue lines. Okay, now I want to show you that same fall, but vertically. So now there's a blue vertical line going through both the bond chart at the top and the stock chart at the bottom. This is January 2018, and the stock market during these two blue lines fell 6.7%. Now, during the exact same time period, the bond market fell 2.44%. So back in 2018, January, when the market fell 10%, I sent an alert out to all of my subscribers and said, don't worry, this is just a price correction, nothing to worry about. And part of the reason I knew this is because bonds were falling with stocks, which is always you shouldn't say always, which is almost always a sign that it's just a price correction in the stock market. Now then, let's move forward to September of 2018, and I want to show you the same 6.7% correction. Okay, so I'm going to show it to you between these two blue vertical lines. The lower part of the screen, again, is the stock market. The upper part of the screen is the bond market. The stock market fell 6.7% in September between the two blue lines. And notice what happened with the bond market. It also fell, but this time it didn't fall 2.44. It actually only fell 1.65. Now, same 6.7%, but it's the second time, right, the market has experienced a 6.7% correction. And this time the bond market did not fall as much. Okay, now let's fast forward to May of this year, May 2019, and let's go with a 6.7% correction, which is what it is. Let me get that. It's about right there. Okay, now I'm going to put it between two blue vertical lines. So now between these two blue vertical lines, we have the S&P falling the same 6.7%. But this time the bond market takes off. It explodes higher. It goes up 7.4%. Guys, this is the third time the market has fallen 6.7% in 18 months. Okay, less than 18 months, but let's just call it 18 months. And the third time, the bond market absolutely exploded higher. The prices went higher. You can see it up here between the two blue horizontal lines. The price went higher. What this is telling us is that the people who are in the stock market, they don't really want to be in the stock market. People are sick and tired of being in the stock market. And the longer a market corrects sideways, if you can even call the bottom chart correcting sideways, because you can see here we have one new lifetime high, another new lifetime high, and another new lifetime high, right? But what we're learning is people are getting less and less tolerant of these corrections, even if they're less or smaller. Now, the reason I want to bring this up to you is because people, presumably people, say in their 50s, 60s, 70s, and 80s, they're buying the bond market because they're worried, because they've been taught bond equal sign safe. Bonds are safe. Bonds are calm. I bring this up because back in 2015 and 2016, the stock market over about a 10 to 12 month period went sideways too. It fell about 14% twice, and there was some volatility in there. The last time it fell 14%, the bond market spiked very similarly like it's spiking now. It just absolutely took off to the upside. And the reason I'm bringing that up is because ultimately, I believe the stock market is going to break up and out. I'm all right with me being wrong, but right now, that's my expectation that the market wants to go higher and it's looking to go higher. The reason I point out the bond market being the place of maybe concern or volatility is because when the stock market broke out in 2016 to the upside, eventually TLT fell 18%. That's 18 percentage points. I'm willing to bet most people buying TLT today or buying the bond market, they're not expecting, let's just stick with TLT, they're not expecting an 18% fall as the stock market moves up and out. And that's why I continue to be more worried about the volatility in the bond market. And we have just seen this right here. What is this actually time span I'm showing you on the screen here? It's 2 years. That's why I believe that the volatility, of course, is going to return to the stock market, but everyone's expecting that. What they're not expecting is it returning to the bond market. And that's what's going to hurt people. And it's something we kept an eye on in 2015 and 2016 and 2011 when the market fell 20% and 2008. And one of the reasons is we just keep things super powerfully simple with Fearless Wealth Research, right? We sit at the intersection of the stock market and the bond market. And when we do that, we can really get the clear, powerful signals. And that's why people are able to see and filter out noise and information a way that they were never able to before. So thanks guys for being with me, and this is just another step in helping you protect and grow your future. Again, this is RC Peck. Take care.